This is our last video for 2023, and what a year it has been. Most of us will remember it for the newer heights the markets made. But that's not all. There were many other notable things about 2023, and today we will see what we can learn from them, of course, from the investment perspective. But why worry about something that's past? Shouldn't we be looking ahead? Well, as they say, the seeds of the future are often sown in the past. So one must look back to get an idea of what the future may hold. And that's why we compile the lessons in this video. Hello and welcome to ET Money's YouTube channel. But before we start, a quick update. The tax saving season is going on. You can get all tax saving options, ELSS mutual funds, NPS, life insurance and health insurance on the ET Money app and invest in them without any paperwork. Plus, you can get instant tax proofs as well. I've also given the link of our video on tax saving in FY 2024 in the description. This video will help you not just save tax, but also pick the right tax saving products. Okay, let's now look at the first lesson from 2023. The Nifty 50 reached a high of about 20,000 during the year, but it also made a low of under 17,000. There were three major corrections during the year. First one from 1st January to 20th March. Second, from 20th July to 21st August. And the third one from 15th September to 26th October. But not only did the Nifty 50 overcome these, but it also kept making newer highs. Now at each correction, it looked like a crash was due. After all, there are crises like the ongoing Russia-Ukraine war, the Israel-Hamas war, rising yields in the US market and so on. But the Nifty 50 braved all of them and kept going up. A monthly SIP in the Nifty 50 in 2023 has delivered a fantastic return of 29% as of December 8, 2023. The trailing one-year returns, on the other hand, are at 17%. So SIPs did much better than lump sums thanks to the three interim corrections which helped lower the investment cost. So the first lesson is also the classic investment lesson. Don't be afraid of short-term corrections. Keep investing through SIPs. See corrections as opportunities to lower investment costs and not as threats that must be avoided. If you are confident about the Indian economy in the long run, there is no reason you should think of quitting. Okay, this was the first lesson. Now that we have started a discussion about the market rally, the natural thing to talk about next is mid and small caps. Mid and small caps had a fantastic 2023. The Nifty Mid Cap 250 index generated returns of 39% and the Nifty Small Cap 250 generated 43% as compared to the Nifty 50 17%. Naturally, many investors would have liked to increase their allocation to mid and small caps, but that wouldn't have been a great idea. Here's why. On your screen, you can see the worst 1 day, 1 week and 1 month returns of the large cap, mid cap and small cap indices. So if the market suddenly tank, a high allocation to mid and small caps can also burn your fingers as the accumulated gains in mid and small caps can also quickly vanish. So the smart thing to do during the period like we are seeing now is to restore your market cap allocation to what you initially wanted it to be. For instance, if your portfolio had a split of 50-35-15 in favor of large, mid and small caps, it was time to sell part of mid and small caps and buy large caps. Alright, let's move to the next lesson now. 2023 can best be called as the year of PSUs. As against Nifty 50's 17% returns, the Nifty PSU Bank returned about 30% and the Nifty PSE index registered a whopping 76% rise. But if we go back a couple of years, PSUs were in the dust. They had been severely underperforming and investors had virtually written them off. But just like we see in a Bollywood movie, things turn around dramatically for them. So what's the lesson here? First, don't write off any sector or theme completely. All sectors go through ups and downs. During the down phase, a sector often becomes the storehouse of value. This value is an unlock during the up phase, as we are seeing in the case of PSUs. On your screen, you can find various sectoral indices and their performance vis-a-vis the Nifty 50 over the last 5 years. The highlighted cells show returns less than those of Nifty 50 in a particular year. Now, the services sector has underperformed the Nifty 50 for 4 years in a row. Could it be the next blockbuster? Well, we can't be sure, but there sure are funds that invest in value or contra theme. You can consider them if you are interested in value investing. Another way to take exposure to value stocks is through the Nifty 50 Value 20 Index. We have discussed the performance of this index in one of our videos. I have mentioned the link in the description, so do check it out. When the markets go up, dismissing your asset allocation and investing more in equities is tempting. After all, isn't it prudent to ride the wave and make hay while the sun shines, right? Well, no. Your asset allocation is your guiding star that must not be ignored. Asset allocation and its close cousin rebalancing have an important role in any portfolio. First, they help you control risk in the portfolio. When you restore your asset allocation, you buy the asset class that has underperformed and sell part of the asset class that has outperformed. Doing this helps you allocate capital to the asset class that is likely undervalued. Second, it takes care of profit booking and dilemma of when to buy and sell. Now, most investors face the dilemma of when they should book their profits from equity. If you rebalance your portfolio to restore the asset allocation, profit booking automatically happens. Your asset class also tells you what you should buy and sell at the moment. If the equity portion has dipped in your desired asset allocation, buy equity, else buy debt. Third, it can help contain volatility in your portfolio. Now, having fundamentally different asset classes in your portfolio can help reduce portfolio volatility. Now, equity, debt and gold are the three classic legs of any long-term portfolio. These three asset classes have performed differently over the years. Now, on your screen, you can see the yearly performance of Nifty 50, short duration funds and Nippon's gold ETF. These three are proxies for equity, debt and gold respectively. There were years when equity did well and there were years when gold was better. When equities didn't do well, debt would have cushioned the fall. Now, some investors are unsure whether they should add gold to their asset allocation. In 2023, while the Nifty 50 delivered 17%, gold did well too at 11.5%. Thus, it was a prudent choice to add gold to the asset mix. Now, in terms of the average 5-year rolling returns, gold finds itself between equity and debt in terms of returns. While the gold has delivered 9.29%, equity and debt have delivered 12.19 and 7.32% each. Now, gold's performance shows that it is a worthy contender in asset allocation, and there is no shortage of options to take exposure to gold, from gold funds to physical gold to digital gold and gold bonds. I have mentioned a link in the description of one of our videos on the options to invest in gold. This video is from another channel of ET Money called 5-Minute Finance, where we explain the key concepts of money and finance in under 5 minutes. Alright, let's move to the next lesson now. A last moment change in the union budget for FY24 was a bolt from the blue for debt fund investors. The finance minister removed the indexation benefits that debt funds enjoyed for investments over 3 years. Due to this, debt funds may not be the automatic choice for fixed income investments going ahead. Earlier, if you sold your debt funds after 3 years, you would get indexation benefit. Post-indexation, the gains would be taxed at 20%. Now, indexation allows you to adjust your gains as per inflation, so it brought down your taxable gains. Now that the indexation is gone, you need to be more careful about where you park your short-term corpus. Your fixed income options are now summarized in the table on your screen. Let's see them one by one. For investments up to 2 years, one can invest in FDs or arbitrage funds or debt funds. The suitable debt fund categories for this horizon include overnight, liquid, ultra short duration, low duration and money market funds. But do remember that the gains from FDs and debt funds will be added to your income and taxed as per the slab rate. Now, arbitrage funds have an equity-like tax treatment. That means the gains booked within 1 year are taxed at 15% and those booked after 1 year are taxed at 10% beyond 1 lakh. But these funds don't have equity-like volatility. They provide steady returns like debt funds. So given their tax treatment, arbitrage funds have an edge if you're looking to invest for up to 2 years. Now for investments between 2 and 4 years, you have debt funds and equity savings funds. The suitable debt categories include short duration, medium duration, corporate bond and banking and PSU funds. The gains from your debt funds would be taxed as per the slab rate. On the other hand, equity saving funds have an equity-like tax treatment and also a higher return profile. But do keep in mind that these funds invest about third in equity, so they can be volatile. But if you can tolerate a slightly higher volatility, equity savings funds are a better option for this time frame. Now coming to beyond 4 years, you have a number of options. The first is of course debt funds. The suitable categories for this horizon include short duration, medium to long duration, corporate bond, banking and PSU and gilt funds. The gains from these funds would be added to your income and taxed as per your slab rate. Then there are equity savings funds about which we talked a short while ago. Next are traditional insurance plans. Don't be surprised to see this option here. Traditional insurance can be considered a long-term debt instrument which gives tax-free returns. But you will need to ensure that the returns from such plans are around the 10-year GSEC yield. That's currently around 7.3%. And for tax-free returns, two conditions must be met. Number one, the annual premium should be less than 5 lakh. If the annual premiums are more than 5 lakh, the maturity proceeds are taxable. Number two, the annual premium should be less than 10% of the sum assured. If they are more than 10% of the sum assured, the maturity proceeds are taxable. The next option for this time horizon is small savings schemes such as PPF, Sukanya Samriddhi Yojana, National Savings Certificate, etc. These products all have a lock-in of some kind and hence they can be considered as a long-term FD. However, their maturity proceeds are often taxed. The only exceptions are PPF and Sukanya Samriddhi Yojana. Their maturity proceeds are tax-free. Now you may be wondering why we haven't considered FDs for beyond the 2-year investment horizon. That's because FDs tie up your capital. So if you end up investing in an FD when the interest rates are at a low, you will have to contend with low interest rates for an extended period. Even if you have made an FD when the interest rate cycle is at a high, there is no surety that when the FD matures, interest rates will continue to be high. You may have to reinvest at a lower interest rate. This is called as reinvestment risk. Of course, you can prematurely exit the FDs, but doing so will incur a penalty. So in our view, FDs are a good option for up to 2 years of investment horizon. With this, we have come to the end of this video. If you did like the lessons learned in this video, do share it with your friends and family. And I will see you next in 2024. Wishing you a happy new year and have a great year ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.